A company worth $47 billion nearly hit zero in a matter of weeks, and almost nobody outside the deal room saw it coming until it was already happening. That company was WeWork. Strip away the branding and the business was simple. It rented desks and office space. It signed long leases on buildings, subdivided the space, and rented it back out at a markup, with nicer furniture and free beer on tap. That is a real estate operating model. It has existed for decades under different names. But in early 2019, WeWork was privately valued at $47 billion, a number that made no sense for a company leasing desks, unless you believed it was something else entirely. None of this happened in a vacuum. The years leading up to that valuation were a period when private investors were pouring enormous sums into fast-growing startups, often prioritizing growth and market share over profitability, betting that scale would eventually produce margins. In that climate, a company that could tell a big enough story about the future was often valued less on what it currently earned and more on what investors believed it could someday become. WeWork was not unusual in benefiting from that climate. What made WeWork unusual was how far the gap between story and substance was allowed to stretch before anyone with real authority to say no actually said it. Investors did believe that, largely because the founder never described the business in real estate terms. He did not talk about square footage. He did not talk about lease terms, occupancy rates, or the spread between what WeWork paid landlords and what it charged its own tenants. He talked about elevating the world's consciousness. He talked about community, about a movement, about a company that happened to also have desks in it. That language mattered more than it should have, because it reframed a landlord as a technology platform, and technology platforms get valued on growth and vision. Landlords get valued on cash flow and lease liabilities. The gap between those two valuation methods is where $47 billion came from. This is worth sitting with, because it is not really a story about one eccentric founder. It is a story about how private capital markets work and where their blind spots are. When a company is private, its valuation is set in negotiated funding rounds between the company and a small number of investors, not in an open market with thousands of participants pricing shares every second. Those investors do real diligence, but they are often competing with each other to get into a hot deal, which creates pressure to move fast and trust the story rather than slow down and stress test it. There is no independent analyst community publishing skeptical research notes on a private company the way there is on a public one. There is no regulator requiring detailed periodic disclosure. For years, a private company can grow a valuation almost entirely on narrative, momentum, and the credibility of who else is already invested, without ever being forced to answer the question a public market asks by default, show me the numbers. Think about how a bank evaluates a loan application versus how a group of enthusiastic private investors evaluate a hot funding round. A bank has a standardized process, is emotionally uninvested in whether you get the money, and is specifically trained to look for reasons to say no. A private investor competing to get into a deal that 10 other funds also want is under the opposite pressure. Move fast, don't be the one who asks the question that kills the deal and gets you frozen out of the next one. Neither posture is irrational on its own, but when enough capital flows through the second posture for long enough, without any equivalent of the first posture ever showing up, you get exactly the dynamic that let a real estate company's valuation drift further and further from what its lease economics could support. WeWork avoided that question for years. Then it stopped being able to. The company filed paperwork to go public, and that single procedural step changed everything. Because going public means opening the books to outside analysts, and outside analysts have no loyalty to a founder's story. They read filings looking for what the story leaves out. What they found once they finally got a real look at WeWork's numbers was rough. There were massive losses, the kind that raise an immediate question about how the business actually makes money once you take away the ability to fund growth with the next private round. There were murky related party deals, including situations where the founder personally profited from leasing his own buildings to the company he ran. And there was a governance structure that gave that same founder outsized control, even as the conflicts of interest around him kept growing. It is worth slowing down on that related party detail because it is the clearest management lesson buried in this whole case. A related party deal is any transaction where the person making the decision on behalf of the company also personally benefits from that decision. In this case, the founder owned buildings, and WeWork, the company he ran, leased space in those buildings. Every dollar WeWork paid in rent on those specific properties flowed partly back to him personally, outside of his compensation as an executive. That is not automatically illegal. Founders and executives are allowed to have outside business interests. But it is exactly the kind of arrangement that healthy corporate governance is built to catch, disclose, and constrain, because the person approving the deal and the person profiting from the deal were the same person. In a well-run private company, arrangements like that go through an independent committee, get benchmarked against market rates, and get disclosed clearly to investors, and, eventually, to the public if the company ever files to go public. The problem at WeWork was not that a related party deal existed. It is that the surrounding governance structure was not strong enough to make sure it was checked. That governance structure is the second half of the story, and it compounds the first half. Outsized founder control means fewer checks on exactly the kind of decision the related party deals represent. When one person holds enough voting power to overrule a board, or enough personal authority that a board is reluctant to challenge him, self-dealing does not need to be hidden. It just needs to go unquestioned. That is a much lower bar to clear, and it is a much more common failure mode in growing companies than outright fraud. Nobody has to lie. People just have to decide, individually and repeatedly, that this is not the hill to challenge the founder on, until the pattern has been running long enough that unwinding it becomes its own crisis. There is a reason this dynamic is so common, and it is worth naming directly instead of treating it as a mystery. Charismatic leadership and internal challenge are structurally in tension. A founder confident enough to convince global investors that a real estate business is a consciousness-raising movement is also, almost by definition, someone whose internal team finds it socially expensive to push back. Confidence reads as competence, even when the two have nothing to do with each other. Boards populated partly by allies and partly by investors who already have a financial stake in the story being true are not a neutral audience. This is not a WeWork-specific flaw. It is a predictable output of concentrating narrative-setting power and decision-making power in the same person, which is exactly why deliberately separating those two things is one of the more underrated jobs of good governance. Here is the part that should genuinely surprise you if you have not looked closely at this case before. None of this was hidden in some deeply buried footnote that took a forensic accountant to find. Once the company filed to go public and the numbers became available, the losses, the related party deals, and the governance concentration were all sitting there in plain language, readable by any analyst who bothered to open the document. The story had survived for years, not because the facts were secret, but because almost nobody with real financial scrutiny had been forced to look at them directly until the public filing made looking mandatory. That is the actual mechanism here, and it is a much scarier one than a cover-up, because it means the failure was not deception, it was the simple absence of anyone whose job it was to ask hard questions early enough for the answers to matter. Within weeks of that scrutiny actually landing, the planned public offering collapsed entirely. It was not renegotiated to a lower price and pushed through later. It was pulled. The valuation, which had stood at $47 billion, cratered by tens of billions of dollars almost overnight, not because the desks got worse or the leases changed, but because the market's estimate of what the company was actually worth, once you looked at it as a real estate business carrying real estate liabilities instead of a technology platform carrying a growth story, was a fraction of the private number. The founder was pushed out not by regulators and not by employees, but by his own major investor, the very capital that had helped inflate the valuation in the first place, recognizing it needed new leadership to survive what came next. Thousands of employees lost their jobs in the restructuring that followed. People who had no role in negotiating lease terms or structuring related party deals, absorbing the consequences of decisions made far above them. What makes this case genuinely sharp for managers, and this is the part worth sitting with longer than the headline numbers, is that the failure here was never really about real estate. Plenty of real estate companies are healthy, boring, profitable businesses. The failure was about how far a story can travel before something forces it to meet a balance sheet, and about how long an organization can run on unchecked internal decision-making before that gap becomes unmanageable. Private funding rounds let WeWork avoid public-style scrutiny for years. Inside that gap, insiders benefited from decisions nobody outside the company was positioned to challenge. The moment independent outside analysts finally examined the fundamentals, the entire structure buckled, and it buckled in weeks, not years, because years of accumulated, unexamined risk does not unwind gradually once it is exposed. It unwinds all at once. There is a useful physical analogy here, even though the case is financial rather than mechanical. A structure under sustained, unexamined stress does not usually show visible damage while the stress is accumulating. It looks fine, right up until the point where the accumulated stress exceeds what the structure can bear, and then the failure is sudden and total rather than gradual. WeWork's valuation behaved exactly that way. For years, it looked fine from the outside, because from the outside, almost nobody was measuring the actual load. The moment someone finally measured it properly, the failure was not a slow correction. It was closer to a collapse. Here is where this stops being a story about one company and starts being useful for anyone running a team, a project, or a budget, even one nowhere near $47 billion. Every organization, no matter how small, has some version of a private funding round, a period where growth, momentum, or a compelling narrative substitutes for hard scrutiny of the actual numbers. Maybe it is a project that keeps getting funded because leadership likes the story more than they have checked the metrics. Maybe it is a manager who has enough internal credibility that nobody on the team is willing to challenge a spending decision. Maybe it is a vendor relationship, a hiring decision, or a resource allocation call that would look very different if someone with zero stake in the story reviewed it cold. The mechanism that broke WeWork is not exotic. It is the ordinary human tendency to let a good story stand in for a hard number, especially when questioning it means confronting someone with power and confidence. Here is what makes this actually matter for managers specifically, beyond the general lesson about scrutiny. Compare what happened at WeWork to how healthy private company oversight is supposed to work. In a well-governed private company, related party transactions get routed through an independent committee that has no personal stake in the outcome, and that committee has real authority to reject or renegotiate the deal. Board seats are not purely decorative. Independent directors are expected to ask uncomfortable questions in the room, not just nod along and save the questions for the hallway afterward. Financial reporting to the board is detailed enough and frequent enough that losses and burn rate are visible long before a public filing forces the issue. Founder authority is balanced against real checks, not because founders are assumed to be dishonest, but because concentrated authority without checks is a structural risk regardless of who holds it. None of that requires being a public company. It requires deciding, before growth and momentum make it politically difficult, that internal scrutiny is not optional. There are concrete, unglamorous mechanisms that make this kind of oversight real instead of aspirational. Related party transactions get logged in a register that someone outside the transaction actually reviews, not just filed and forgotten. Independent board members get real information packets before meetings, not a summary curated by the person whose decisions they are supposed to be checking. Someone in the organization has an explicit mandate and enough protection to escalate a concern about a leader's decision without that being a career risk. None of these mechanisms are expensive or exotic. They are just easy to skip when everything appears to be working, which is precisely when they matter most, because by the time something visibly stops working, the unchecked decisions behind it have usually been compounding for a long time. The practical version of this for anyone managing people or budgets is a habit, not a one-time audit. Ask, on a regular cadence, not just once a year, whether the plan in front of you would survive contact with a skeptical outsider who has no loyalty to the story and no stake in your success. Not a friendly colleague who wants the project to succeed. Someone who owes you nothing and would happily tell you the plan is weak if it is weak. If you cannot picture how that conversation would go, that itself is information. It usually means nobody internally has been playing that role, which is exactly the gap that let WeWork's numbers go unchallenged for years while the story kept outrunning the fundamentals. This also means being honest about related party dynamics at whatever scale they show up in your own organization, because they rarely show up as dramatically as a founder leasing his own buildings back to his own company. They show up as smaller, quieter versions. A manager who steers work toward a vendor they have a personal relationship with, a team lead who protects a pet project because their own reputation is tied to it, a leader who is evaluating a decision they themselves championed and has every incentive to see it succeed on paper. None of that requires bad intent to become a problem. It requires the absence of anyone positioned and empowered to ask the uncomfortable question early. The honest, uncomfortable part of this story is that waiting for an external event, a filing, an audit, a new hire who is not yet invested in the existing story to force the scrutiny is waiting far too long. By the time an outside party is the first one to seriously question the numbers, the gap between the story and the balance sheet has usually had years to grow, and closing it fast, the way WeWork's valuation closed fast, tends to be brutal rather than gradual. The $47 billion number was not fake in the sense of being invented from nothing. It was real in the sense that real investors paid real money based on it. What it was not was tested. And untested numbers, at any scale, are only ever one honest outside look away from finding out what they were actually worth all along. The practical takeaway is not complicated, even if applying it consistently is hard. Build the skeptical outsider into your own process, before the market, an auditor, or a public filing does it for you. A company that was worth $47 billion nearly hit zero in a matter of weeks. Not because the underlying business changed overnight, but because the scrutiny that should have been happening continuously finally happened all at once. Do not let your own numbers wait that long to meet their balance sheet. Hit follow if this changed how you see your team.